This is a short video on dividends. Now, what a dividends is a percentage of the profits that is paid as a return to shareholders for their investment. So, as it's provided to or paid to shareholders, it belongs to obviously the private sector within public limited companies and private limited companies. Now, just remember the difference between a public and a private limited company. A public limited company, a PLC, is where you can buy shares in the stock market, and an LTD, which is a private limited company, is where you are invited to invest within a company. So, as I've put here, dividends is it's a distribution of a portion of a company's earnings, and it's decided by the board of directors, and it's paid to a class of its shareholders. So it can be issued as cash payments, as shares of stock, or other property. And I've just bullet pointed some key points that you should know as well. So as I said before, the board of directors are the ones that choose to issue the dividends. Now they might have different corporate objectives, they might have different aims, and for example, some of that might be to retain the profit to kind of reinvest within the company and help it to expand. If that was the case, then dividends wouldn't be their priority, and they'd maybe reduce the amount of dividends that is paid to its shareholders. But it's the board of directors that decide. So a company's net profits are an important factor in determining a dividend. So obviously the higher the net profit, the stronger the possibility of greater dividends. So firms can decide to retain the profit, as I've said before, which will reduce the rate of dividends. They can also use their profit to buy back shares. So this, again, it might happen, and I'm sure you've seen this question before. What may be the benefits of changing ownership to a private limited company? Now, the way they would do that is they would do a share buyback scheme, okay, where they would try to regain that control over the company by taking it off the stock market. So obviously, as an investor, dividends would be a priority in terms of choosing the company that you would invest in, and often when deciding whether to invest into a company, you're obviously looking at the rate of return, and that's the dividend yield. So dividend yield is the rate of return on the dividends that you'd expect to get back. So you can calculate this via a financial ratio. Now in GCSE you won't need to worry about this, but it gives you a good idea as to how they calculate the dividend yield, and also in terms of how it helps investors to make decisions. So what they'd work out is the annual dividends per share, which would be given to you, divided by the price per share that should also be given to you, and it would be shown as a percentage. So I've just given you a little example below. So imagine you've got an investor that is deciding to invest whether into company A or into company B. They've seen that annual dividends is $1 per share, whilst the price per share is $20. They look at the dividend yield annually at 5%, but company B is again also $1 per share. However, the price per share is $40. So what you'd find is the dividend yield on that is 2.5%. So again, if you were concentrating on maybe short-term returns and not no other factor about these companies, not about its long-term potential, not about the type of market it's in, but if you were just solely caring about short-term gains, then you might go for company A.